So I track my investment portfolio every single day for a month, and in today's video I'm going to share with you guys the results on exactly what happened. The idea really stemmed from a problem that I've been facing, with the problem statement being I have multiple investment accounts and no single view to track all of my investments in one place. I felt somewhat detached from my investments, which some might say is a good thing, but then again you can't manage what you don't measure. So I came up with a plan to create my own personal investment portfolio tracker, which I would then use to gather data on my investment portfolio and to help better inform my investment decisions. It's kind of the same philosophy behind running this YouTube channel. I check my analytics in the comment sections of my videos to find out people like Baby Yoda like the video, and the more people that go on to comment and view the video itself, the more I know to make more videos on that specific topic, and therefore over time the channel goes on to perform better. So applying the same principles of gathering data on my own investment portfolio to help it perform better seems like a sensible plan of action. So every day I went on to track my investment portfolio, and well, it's been quite a tough month. We've had what's been described as a brutal month for stock market returns, which has turned out to be just another consecutive month of losses in the stock market so far this year. The Nasdaq is already in a bear market and is currently down 22% year to date, and the S&P 500 is down 13% and certainly in a market correction. There's certainly no beating around the bush here. US as well as other global equity markets are certainly suffering, just like me who's caught the coronavirus and is struggling through making this video. And aside from that, there's no escaping the losses by looking at the cryptocurrency market, because that's seeing the same fate too, with the two big players, Bitcoin and Ethereum, being down 12% and 18% respectively. So with such tough market conditions and the price of everything pretty much cratering, I've of course been closely monitoring the value within my investment portfolio. Every single day I've been very focused on the change in value of that portfolio in order to be able to understand whether I need to make any changes moving forwards, which hasn't exactly been helped out with a rough month of reporting in the media. The month started off with April Fool's Day, which certainly wasn't any joke, as the Eurozone inflation rate hit 7.5% as energy prices skyrocketed. By the 4th, the Treasury yield curve inverted, which certainly sent signals of a potential recession just around the corner. Global government debt hit $71 trillion as the US debt clock goes up faster than you could even comprehend. Tech stocks got slammed, UK inflation hit 30-year highs, there was a $615 million crypto heist, the World Bank slashed global growth forecasts, and Netflix stock cratered 35%, Elon Musk buys a majority stake in Twitter, US GDP dropped 1.4% in the first quarter, and Warren Buffett rips Wall Street for turning the stock market into a gambling parlor. All this and so much more in one single month. So many news headlines, some good but mostly bad, which certainly reflects the current sentiment within the stock market right now.
I am never going to financially recover from this.
And as a result, it's been a pretty wild month for my investment portfolio. It's certainly been volatile and the value of it has fluctuated massively, which kind of makes me ask the question, how often should we be paying attention to all of the press and the news, and how often should we actually be tracking our own investment portfolios? Because all of this reporting can be somewhat of a distraction and can sometimes lead to decisions that may actually hinder your long-term investment performance. It's simply just the way we're wired, with the constant flow of information and doom and gloom activity predominantly publicized in the media. It results in the fear and greed index going off the charts and sparks a frenzy of selling amongst stock market investors. And well, it can be also easy to follow the crowd, especially when the value of your investment portfolio seems like it's plummeting every single day. But as Warren Buffett once says, buy, hold, and don't watch too closely. And whilst what I'm about to do perhaps isn't the advised approach, because perhaps you could take a little bit more of a passive approach to actually monitoring the value within your investment portfolio, I still thought it would be quite a good exercise to actually do and share with you guys just how a real investment portfolio can actually fluctuate every single day for a whole month. So to do this, I've been plugging the numbers into my own personal portfolio tracker, which captures all of the live market updates on all of my investments, which I currently have held across Trading 212, Vanguard, Crypto.com, and Coinbase. And as you guys can see, every single day I've been tracking 6 different variables. But what's particularly of interest in today's video is the change in the unrealized gains of the portfolio. So we started the month off with gains of £8,589. before seeing the investment portfolio peak at a value of £10,013, which was actually up 16.5%, which was pretty good going. But those unrealised gains on the investment portfolio quickly took a tumble, down to just £7,572, with 24.3% of the total portfolio unrealised gains being lost. Total volatility for the month was 11.8%, which is a pretty sizable fluctuation in value month on month. And it's great to know this kind of data, but how does it help me as well as you guys who look after and manage your own investment portfolios, manage your investment portfolios better? Well, the first key thing is that having access to this information allows you to reassess your exposure to risk. Because in essence, every investment that you make is a risk. Companies like Vanguard categorize their funds with risk ratings between 1 and 7, but when you're investing into individual stocks and cryptocurrency, you kind of just have to use your own judgment. Of course, you've got some lower risk stocks which sit on the lower risk end of the spectrum, whilst you've got some more speculative higher growth plays which sit on the high risk end of the spectrum. And if you've somehow managed to find yourself investing solely into more speculative high growth stocks at the higher end of the risk spectrum, and it's making you lose sleep at night, well, you probably want to reconsider your overall exposure to risk. Now, to do this and to actually analyze your investment portfolio in a little bit more detail, we can look at something called a market beta. Now, the market beta is this fancy formula which essentially measures a stock's volatility in relation to the broader stock market. So the S&P 500 has a market beta of 1. So we know if a stock has a market beta higher than 1, then typically it's going to be more volatile than the broader market, being the S&P 500. Whereas if it's got a market beta lower than 1, then you know that that investment is going to be slightly less volatile than that of the S&P 500. So let's look at some of the investments within my own investment portfolio to benchmark against the volatility of the broader stock market. So of course I have acquired the Vanguard VUSA S&P 500 ETF, which obviously has a market beta of 1 and a 5-year return on investment of 73.19%. But then when we move to look at more individual stocks, like Apple as an example, which sits at one of the biggest holdings within my investment portfolio, Apple currently has a market beta of 1.19, suggesting slightly higher levels of volatility than the broader stock market. But then having said that, it does certainly outperform the broader stock market with 5-year returns of 324%. Then we've got the likes of companies like Tesla, who have a market beta of 2.08, suggesting that they're 2 times more volatile than that of the broader stock market. As a result, when things are going good, you can expect Tesla to do very well. However, when things are going bad, you can expect Tesla's stock to be certainly worse than the broader market itself. But with this additional volatility and risk which you've taken on, well, over the course of the past 5 years, you've certainly benefited from returns of 1,368%. But what if I wanted to actually reduce the overall volatility within my own investment portfolio? Well, I could go on to look at some more safer bet stocks, like Coca-Cola as an example, who currently have a market beta of just 0.66. However, with a lower market beta, you do typically get lower returns, with Coca-Cola only returning 45.2% in the past 5 years. So I guess these are the kind of things that you're probably going to want to ask yourself when you're analysing and managing your own investment portfolio. How much risk do you actually want to take on, and are you comfortable with that level of risk? And if you are you also happy with the potential upside and the potential rewards that you have on the table too? So having access to this level of investment portfolio data is of course important to reassess your exposure to risk. But it's also important to help inform when you can actually rebalance and when you should rebalance your own investment portfolio too. Because every single year, big fund managers actually go on to rebalance their portfolios. And this is all about sticking to a portfolio asset allocation which you've set out. For me, my own personal asset allocation is what I've classified as the difference between my investments versus my more speculative assets. And the allocation that I'm personally working towards is to have 90% in investments and 10% in speculation. And as of right now, I'm currently sat with 91.8% in stocks and ETFs, or my investments, and 8.2% in cryptocurrency, which is my speculation. So I'm a couple of percentage points off my desired portfolio allocation. And as a result of having this data, there are a couple of things that I can do. First, I can sell a portion of my stocks or ETFs, or as an alternative, I can look to add value and invest more into my cryptocurrency portfolio. But for me, I'm not exactly one for selling, because ultimately all of these holdings are long-term investments that I've made. So if anything, I'm more likely to add to this portfolio rather than and take away from it. But what I certainly do have is the data to back all of this up. So I know when and what assets are under allocated within my investment portfolio. And from having that level of information, I can then go on to calculate what any shortfalls are for me personally to then invest and add more back into this investment portfolio. But if your own personal investment portfolio is perhaps fluctuating a little bit too much than you'd ideally like, then obviously assessing and rebalancing your investment portfolio and your asset allocation might be something that you want to consider. Start to take a little bit more of a deeper look into your percentage in cryptocurrency, individual stocks, and whether they're kind of your safe dividend stocks or more high growth speculative stocks, along with your ETF exposure too. If you've got a far higher allocation towards stocks and cryptocurrency, resulting in a highly fluctuating investment portfolio that makes you feel somewhat uncomfortable, then the alternative option may be to actually look into perhaps some lower volatility ETFs instead in order to balance it all out. Because building an investment portfolio and managing that investment portfolio is all about having an unemotional balance between risk and reward. Taking on the risk that certainly makes you feel comfortable, but also being able to put yourself in a position where you're going to benefit from all of the rewards from taking on that risk over the course of the long term. And then finally, the third reason why it's important to have this level of information and why I personally track my investment portfolio is so I can actually take advantage of opportunities. From monitoring the changing value of my investment portfolio, I can certainly spot the peaks and the troughs and the trends of the portfolio. And from doing this, I can actually analyze where there is potential to make additional investments to my investment portfolio. As an example, in the later half of the month, I noticed that the value of my investment portfolio was falling. And as a result, I made 2 additional investments of about £250 over the course of those couple of days. And whilst my investment strategy is predominantly to just cost average my way into the market, I do also like to take advantage of market opportunities as and when they present themselves. Now, there's certainly not a one-size-fits-all approach to investment portfolio management, and whilst I've done this as a little bit of a trial of monitoring my investment portfolio every single day for a whole month, that of course might not work for you, and you might want to look at your portfolio perhaps once a week, once a month, perhaps even once a quarter. But nonetheless, if you would like to use the same tool which I personally use to track your investment portfolio too, then I'm going to leave a link to this tool down in the description below. But before you go, if you do want to know a little bit more about how I execute on my own personal investment strategy, then be sure to click on this video here. With that being said, I'll see you over in the next one.